The market has moved like a slug so far this week and has not offered up a ton of clarity in terms of price action itself, and instead has left a slimy trail of bad structure behind us, which we'll see on the market profile in just a moment. Perhaps the biggest clues for this market actually come from a behind-the-scenes look at intermarket dynamics, and to be honest with you, they're not looking fantastic as of right now. It's a mixed bag of signals which isn't really giving me confidence for a breakout to continue from this balance range move right around here. We'll get into all of that and more in today's episode of the Midweek Market Update. Make sure to check out the links listed down below, hit the thumbs up button, and subscribe if you've not done so already, and stay tuned until the very end of today's show. I've got 2 additional trade ideas to share with you that you won't want to miss. With that said, let's kick things off here on our SPY daily time frame chart. Let's be very clear that we're still dealing with an overall daily uptrend. We're continuously producing lows, higher lows, and along the way highs, higher highs. And as of Tuesday's gap up, we did technically just produce a brand new set of higher highs. So is it reasonable that the market could afford a pullback and still be in a daily uptrend? The answer to that question is 100% yes. But as we've seen so far this week, 411.75, the top end of this balance area here, has continued to already act as support. Specifically on the Monday open, we tried to resolve this area, confirmed it as support, and closed above. And to me, that was more of a signal to say, okay, we're trying to resolve this balance area in the upward direction. If we're trying to get a breakout, you would think that on a day with some momentum, aka a gap up in the pre-market, on Tuesday, we should have seen some follow-through. Obviously, it wasn't the case. We faded the gap in its entirety, spent some time inside of the Monday range, and barely closed above the Monday high. So not all that confidence inspiring from the buyers on the Tuesday gap up session. They were unable to materialize on the momentum from the gap up. Okay, so if the buyers are going to be weak, maybe it's going to turn into a good old look above and fail. We'll come back down into range and move underneath 411.75. Buyers are weak, right? Well, on this morning session, we open on a gap down. Is there any follow through to the downside? Absolutely not. We close the gap and then close inside of this new, what is starting to already feel like a new balance range, right? So it's hard to be a bear in this environment when we're still above 411.75, considering that we've broken from the original balance here, and overall the context of this move is an overall uptrend. This is a brand new higher high with the gap up from Tuesday. But with the lack of follow through, it's very difficult to actually position for a move that is going to see continuation, because at this point, since we did not see continuation from Tuesday, we still have to contend with previous resistance off here to the left, unless there's a new catalyst that is going to send prices higher, which it doesn't look likely with Tesla earnings already producing a gap down. I'm just not seeing the convincing case for a long either. So we're stuck between a rock and a hard place here with the S&P not getting follow through on the original balance break here, and also not being willing to fall back down into range underneath 411.75. So difficult chart to trade on the daily time frame chart. Again, there's not a lot of clues here in terms of what trades are likely to unfold based on the price action analysis alone. Now, as we pointed out, the Tuesday gap faded. Today's gap faded. Where have we been seeing some price acceptance? I will say this area has kind of acted like a magnet. That's where we spent the most time on Tuesday, and we started to consolidate there and tried to find a higher low into the close when there was that little pullback here. Now, the reason I want to point this out is because what would this indicate? If new money longs are trying to enter this market and they're trying to participate in upside action, if this is where the new average price is going to start to be considered, right? If people are holding from here, longs late to the party could produce a liquidation break. And that's just a concept that you need to be mindful of in market environments like this, where we're really not seeing any follow through in the upward direction, even though the overwhelming trend is up at this point in time. So if longs late to the party start to close out, this is not something that you want to position early for. It's just a dynamic that you need to understand is in play here. If these longs late to the party close out, that obviously adds selling pressure. I wouldn't be surprised if this market continues to just whipsaw back and forth without seeing follow through if there's not going to be any momentum, aka Tesla earnings weighing on price already. The close was 414.14, and we're currently trading 413.63 underneath, right? So there's, again, just a lack of evidence that really points to big continuation in the upward direction. Be mindful of that liquidation break. It's difficult to be a bigger short as long as price is above 411.75. Hopefully you can see there's the support that steps in on the Monday session. If we were to break down underneath 411.75, that's a different story. I do think that there is a short scalp into 409, the midpoint of the original balance range from here, and then a test of 406. As we talked about in the weekend update, this is a dangerous area to get back into. If you're a long and if you're a short, that's where you want to go, because this should in theory break. When and if it is tested, this is a weak level. We're just not close enough to it as of today's price action, as of this week's price action, holding up above 411.75. So hopefully you can see this is a very tricky chart to trade. I don't think it's really offering any obvious clues if we're just looking at price action alone. Let's dive into some supporting evidence and see what else we can learn. Market internals are always Exhibit A. Here we go. If you're not familiar, top right-hand corner's got you covered with a brief tutorial. What you'll notice is that we do technically have inflows on the week, but they are nowhere even close to being significant as of right now. Significant is 500 million or better in the upward direction, negative 500 million or worse in the downward direction. We're currently sitting at 137 million, so not significant. And you can just see visually that we're very close to the zero line here. We're nowhere even close to positive 300 million, negative 300 million on an individual day's session. So inflows, yes, but nothing impressive, no bullish momentum. The advanced decline line never gets close to trend higher zone this week. So even on the Tuesday gap up, this is kind of the giveaway, right? When Tuesday gapped up and we didn't open here in trend zone higher, that set off some red flags. And we talked about this in the Discord, but for the most part, very neutral on Monday as we hold for support, no momentum on the Tuesday gap up. And this indicates no selling momentum, right? So although we were negative on the gap down, the trend of the advanced decline line is in the upward direction, not really showing any strength from the sellers. And we know that to be true with the price action itself. But again, it speaks to the idea that this market has zero confidence at this point in time directionally, and internals are confirming that. Same thing with the cumulative ticks. Notice how flat these are on the Monday and on the Wednesday session. Tuesday, again, we know that we had a gap close there, a little bit of a negative build, but in the grand scheme of things, it's nothing. Notice how it barely even it's hardly negative, right? So internals confirm a lack of confidence from this market. Let's see what else we've got. Exhibit B, market profile. If you're not familiar with this screen, top right-hand corner's got you covered with a brief tutorial. As we mentioned in the intro, we're actually leaving behind us some pretty terrible structure. What do I mean by that? Well, for the most part, let's talk about the structure first and then value. Notice that we have a poor low on the Monday session. We have a string of single prints here from a early morning liquidation break, aka the gap close on the Tuesday session, and we have another poor low on today's session, right? So overall, these reference points are all important from a profile perspective. Now, considering that the lows are weak, when and if these are tested, we are looking for a breakdown. So that doesn't really make me warm and fuzzy inside about continuation in the upward direction if the market's really lacking confidence at this point in time. What about the single prints? Well, the single prints, in theory, represent thin structure. So why was it that on today's session, as the market did have some strength behind it in the upward direction, we were trending higher into the 2 p.m. session, J period here, why was it that we look into the single prints, the buyers fail to rotate through the single prints? You want to think of singles as weak structure, right? There's really a lack of acceptance up here. The value area does not get into the single prints. The point of control does not get into the single prints. Nothing is really looking good about this market as of right now. There's no reference points that are working as they should. The market's just churning back and forth, grinding up and down and up and down, and it's not seeing any stronger buying or selling type momentum. So knowing that, how do we get involved? Well, I would certainly just carry forward. If we test today's lows, I would target Monday's lows. And if we test Monday's lows, we know that that technically represents a look back down into the original daily balance area. We know that this is a poor low. It should break. Maybe that's what leads us to a move in the downward direction. We're just simply not there yet. So unless these levels are actually tested, it's hard to have confidence in a bearish thesis. We just need to know that they exist. And again, the main proof of this is the fact that the buyers could not rotate through the single print thin structure here. All right, so in terms of value, it's really a mixed bag. Monday's session is low. Tuesday's session is low in the individual profile, but higher. if we're counting this way. And on today's session, it's just overlapping. The point of control is nearly identical, slight discrepancy in the downward direction. The market's not going anywhere, and it's not going anywhere anytime fast. So let's be patient. Let's wait for some of these reference points to break. That's what I've got from the profile perspective. Moving back on over to Thinkorswim to evaluate the weekly performance of our sectors, we'll notice that at the top of the pack, we see the XLRE for real estate up a whopping 2.65%. Unfortunately, it's such a lightweight sector, it doesn't mean a whole lot for the S&P. Doesn't give me a sense of confidence seeing the market trying to break this balance range being led by an extremely lightweight sector. Now, I will concede that just underneath is the XLF for financials up 1.77%, definitely a heavier weight risk on sector. But the fact that the big leader, up by almost a full percentage point above XLF, is real estate doesn't give me a warm and fuzzy feeling for continuation here. At the bottom of the barrel, we're looking at the XLE for the energy sector, which is fine. That's a risk-off lightweight sector, right? Well, just underneath that, we see the XLC communication sector, heavier weight, risk on. Sort of a mixed bag from a posturing perspective here, decreasing the confidence in this upside break so far. Let's check in on the structural charts and briefly evaluate what's going on. Real estate, lightweight sector, sure, it's technically up percentage-wise, but has it done anything impressive from this box perspective? No, absolutely not. If it does continue in the upward direction, it'll help upside outcomes, but it should not lead upside outcomes. So noting that, let's take a look at the XLF. I have to give credit where credit is due. There has been an impressive recovery attempt out of the banking sector now that the earnings cycle has kicked off. The gap and go from JP Morgan last Friday has held, and we have seen continuation. Now, it's completely logical that the XLF could stall out here at the daily 50 SMA, daily 200 SMA, and the upper wick from one of these breakdown bars back here at 33.65. So a top priority for the remainder of the week from a sector dynamic perspective is that if the XLF slows down or sees pullback off of 33.65, you better see follow through out of tech and discretionary if the market is going to hold up above the top of the original balance area. If the XLF pulls back off of here and you're not seeing the follow through out of tech or discretionary, red flag, run for the hills, duck and cover, basically. So that's the XLF 33.65 key watch in this sector. Next up is XLI for industrials, a lighter weight sector, but still sort of important from a posturing perspective, signaling more risk on, right? Industrials, building, industry, things are going well in the economy. As of right now, it's put in an equal high after a higher low from here to here. So we could technically afford a pullback, but if that pullback comes, again, into the end of the week, what does that imply for the S&P? Not a whole lot of confidence in the upward direction. And based on the consolidation in the lower 50% of Tuesday's range on today's session, I'm not all that thrilled about upside outcomes here. Next up, XLP, consumer staples. Now, in the weekly watch list episode from Sunday, we talked about the dynamic of two balance ranges, the XLP being the defensive one and the XLK being the aggressive risk-on one. This has broken its balance range in the upward direction, which does not make me feel good inside. Now, yes, it is a red bar. It technically tried to test resistance as newfound support. We didn't close at the highs, but we still did close above 75.75. So if this is a break retest and we see continuation this week, that should be a red flag considering, as we'll see in just a moment, the position of the XLK still inside of its balance range. This is not a good look for our market. We don't want consumer staples leading any rally attempts. Ideally, this comes back down into range, produces a look above and fail. We target 75 and it's replaced instead by a rally in the XLK. Unfortunately, the price action doesn't look all that convincing that that could be the case here. Let's take a look at the XLB, what's going on with materials, lightweight sector, really just balancing up here at the highs. If it breaks, great. Not going to be a make or break for the S&P itself. If it breaks down, same idea. Not the end of the world for the S&P, really lightweight sector. XLU for utilities. Ideally, this one stays in the balance range right here. This is a D for defensive sector. We don't want it leading rallies. So ideally, it stays under 70 into the remainder of the week. If it's trying to break 70, and that's leading the S&P sort of in an attempt out of its 3-day balance range it's formed so far above 411.75, I would not have confidence in that breakout attempt. Next up, we'll take a look at the XLY, consumer discretionary. We know that there needs to be some solid improvements here. I won't say that the chart looks awful, but it's just not seeing the follow through yet. And with the consideration of Tesla gapping down so far, being a heavyweight constituent of discretionary here, I'm not really convinced that we're going to see a follow-through move tomorrow morning over 148. I would love for this chart to prove me wrong and actually do that, because then, of course, excuse me, we're dealing with an ascending triangle breakout. The target should be up here. This is a heavier weight risk on sector. That would be ideal because we're trying to look at the market. We're trying to find that long setup, considering that the SPY is balancing over 411.75. This would be a supporting piece of evidence if we got a break over 148. But again, with the Tesla earnings so far, I'm not convinced that it's going to be the case. So I'm going to continue to watch 148. We have not resolved it. We've literally closed right on the level for today's session. I wish I had better answers for you, but so far with Tesla earnings being the main driver, I'm not convinced we see a break tomorrow. Again, I would love to be proved wrong, but so far, not looking great. XLK, what's going on with the tech sector? As we alluded to, it was the tale of two competing balances. XLK, XLP. XLP broke out and is looking like it wants to do something like this. XLK obviously saw a fake break of the top of the range. We've closed right back at the pivot 149.15. So it's hard to say that it's just going to completely fail. A complete failure would be underneath 147.25. That's where you duck and cover, run for the hills. It's so close to the balance edge that I think we just need to see how it resolves, right? Ideally, this would have seen follow through on the Tuesday session. I think very similar to the SPY itself. With a lack of follow through from that gap up, trying to get us out of this balance range, you have to at least acknowledge that the buyers are not really all that strong on this given chart. So this is a concern for the market. Hopefully you can see how these intermarket dynamics are really starting to shape the picture that, hey, this breakout attempt, it's not looking good so far. XLE, what's going on with energy? Lighter weight sector, risk off sector. It's balancing here. It's not a threat. Continuing along communications, a little bit of a breakdown from its overhead balance range. But again, this has already done the work. Notice that it broke out, it balanced. It's okay if we get a deeper pullback here as long as the higher low is above 56.75. Unfortunately, we're just not seeing the follow through from the bull side in the XLK, XLY that's required for the market to see follow through in the upward direction. So again, hard to be a short in the S&P itself as long as we're above 411.75, but the sectors are making it very difficult to actually get involved on the long side. Let's take a look at the XLV healthcare sector. Reasonable pullback. We talked about this in the weekly watch list update. Sort of pulling back here is fine. It can easily produce any higher lows above 129.50. I would continue to watch for a rotation higher here, actually considering the hammer candle that swept the Tuesday low, closed up at the highs of today's session. A target would just be the equal high. That would preserve more of a bullish look in the S&P, considering that this is the second heaviest weighted sector by market cap. Here's the ratio grid. If you're not familiar with this screen, top right-hand corner shows you how to set this one up. Overall, the top four listed sectors here are the heavyweight sectors for the S&P. The XLK, the heaviest weight risk on sector, continues to fade. It really needs to catch itself for a higher low and rally away from the upward sloping 50 SMA if it will continue to provide more of a risk on look for our market. The XLV is the second heaviest weighted sector by market cap, but as we know is D for defensive from a posturing perspective. Already trying to produce a higher low here. Doesn't really give me a warm and fuzzy feeling inside for risk on longs in the S&P. XLF, as we know, is rotating higher on the recovery effort from earnings. However, if we stall out at that 33.65 level we just discussed on the structural chart, is it possible that we just produce a lower high here in the ratio and roll back over? Absolutely. Very difficult to see bullish outcomes as we're underneath an aggressively downward sloping 50 SMA here. And the XLY just speaks for itself. Until we can actually break this resistance trend line and get above that here, not really producing any risk on signals for this market right now. The closest tie to the XLK was the XLC communication sector, which was looking pretty darn good in this segment of the chart. Obviously, this week so far, it's given back a lot of its relative strength look. At the bottom four, we see the risk off sectors, and these are the lightweight sectors. They're all risk off. We know the outlier up here is the XLV. These are all risk off. And notice how they're just waiting patiently. Neutral trends across the board here in the bottom four risk off sectors. They're saying, hey, we're ready. Anytime the market's ready to see more of a risk off type environment, we're ready to perk up. We're ready to perk up. We're ready to perk up. So not really thrilled about the posture right now in the market. Even if we take a look at something like the XLY over the XLP, so growth versus value, just like the XLY chart itself, it's still underneath a descending trend line here. It's really got to break and get above that. The one saving grace, of course, is just the fact that we are still technically above the double bottom from here and the nail in the coffin move, which happened into the end of 2022. So it's not game over yet, but as you can see, trusting this breakout in the S&P in the upward direction, not really there quite yet. Checking in on the dollar, what you'll notice is that we're still underneath the bottom of the original range here at 102. I'm still getting these funky doji candles on the chart, so if anyone knows about this, let me know in the comments section. But for the most part, the fact that the dollar stays underneath 102 as we're attempting to break out here is maybe a saving grace, a silver lining, if you will. In theory, a lower dollar should equate to higher equities. And even if we look at something like the gold contract here, and we'll take a look at silver again in just a moment as well, I said in a previous video that we're not going to retest, or we're not going to trust the second retest. First test is always the best test. So far, so good, right? We haven't really seen a solid push away from 2000 in gold again yet, but we did produce a daily hammer candle on today's session. So the theory is if we break out over the hammer high for tomorrow in gold, target the equal high here, that in theory should put downward pressure on the dollar and in turn upward pressure on equities. It's the relationship to continue to monitor, but technically speaking, this setup here with the hammer candle that sweeps the Monday low and then closes back above 2000, it does look good for an attempt over the hammer high to see gold higher into the remainder of the week. I would certainly carry forward that trade for Thursday and Friday. And even if we take a look at the silver contract here, that is SI in the futures, it's the same idea. I know the chart looks really compressed here, but hammer candle sweeps the Monday low, actually closes as a green-bodied hammer over that hammer high, target the equal highs, in theory putting downward pressure on the dollar. Let's take a look over at our interest rates. And what we'll do is we'll bring up the signal study here, because in the past we said, hey, we're getting this red firing in the signal study indicating downside outcomes for equities. Now we're getting a green cross from positive to negative. So could it have been a false signal? Perhaps, but if we just look technically at the TNX chart here, what we're going to do is get rid of the signal so we get a little bit more real estate on the screen here. There we are. The main point to make in this here is that we have just produced an equal high from this balance area after already producing a higher low. So is it reasonable that we see a pullback that then offers a higher low and continues to trend in the upward direction? It's a reasonable possibility, noting that the Fed is likely going to raise rates one more time, and then the pause has actually been extended. So let's look at the Fed tracker tool. Overall, if rates continue to move higher, that would actually put downward pressure on equities here. So it should not come as a surprise here that the tracker tool continues to increase the odds of a 25 basis point rate hike and decrease the odds of a pause in the next Fed meeting, which by the way is May 3rd. And if we take a look at the probabilities tab here, this is what I was just referring to. Notice that now the first rate cut is coming in November. Before it was in September. So potentially pausing at that 500 to 525 basis point terminal rate for longer than what we were anticipating as of last week's close. That is noteworthy here. From an earnings perspective, we don't have the updates from FactSet just yet, but the major reporter was Netflix and Tesla after today's close. So Netflix did see a positive earnings surprise, but they missed on revenues, whereas Tesla saw a positive earnings surprise, but the margins are really the topic of discussion here, being brought way down with more expensive materials and the price cuts, obviously, that Elon Musk has continued to roll out. So demand for the product seems to be going down, cutting into their profit margin. Ultimately, what does that say about the consumer is another possible thing to take into consideration here. People are not willing to spend that higher price tag on a luxury vehicle, right? You could kind of think of Tesla as being the higher end EV against something like perhaps a Prius. So overall, speaking to the state of the consumer, to me, it's not really the best indication for a strong consumer if people are issuing price cuts across the board. Now, Tesla itself is gapping down. We'll get to that chart in just a moment, but let's continue along with intermarket dynamics. So our TLT relative strength line continues to fall off of a cliff, which is not indicative of any flight to safety type trade, which is actually bullish for equities down below, and we're backing firmly away from that 110 breakout level in the downward direction. This is basically inverse to the TNX that we were just looking at, but if this is a bullish sign, this is definitely a bearish sign. Let's take a look at the HYG junk bonds, clearly in a negative divergence to equities. This is quote unquote smart money up top and dumb money down below. Equities continue to just try to grind in the upward direction, and the HYG is saying, hold your horses, guys, chill out. We're not ready for a breakout. You could even draw this in as a clear negative divergence. Instead of higher highs equities and equal highs HYG, it could actually be lower highs in the HYG as well. well. And the big threat here would be if we fall back down into this balance in the HYG underneath 74.75, in theory, that balance, as we know, correlates with the S&P down here. So this breakdown in the HYG is a top watch and a big red flag into the remainder of the week, one of these intermarket dynamics that's not giving us confidence in the breakout over SPY 411 right now. Let's take a look at the digital gold just to see if there's any difference between risk appetite in equities versus crypto right now. And there has been a little bit of a pullback that's unfolded here. However, just like in the SPY, we haven't broken down underneath SPY 411. Bitcoin has not broken down underneath the previous breakout point here at $28,635 per coin in the perpetual futures listed on Thinkorswim. So unless this breakdown actually takes place, unless SPY actually gets down underneath 411.75 to draw a parallel, it's just difficult to be a short before that level violation actually takes place in the downward direction. Breadth indications have also not really improved to any dramatic extent. Notice that new highs versus lows is still very close to the zero line. If we take a look at stocks trading above their 200 SMA in the S&P 500, it did make a small tick in the upward direction so far on this week's worth of trade. So maybe a minor improvement here, but nothing significant. The best one so far, this is going to be the best one, and then we're going to erase it with some negative data points, as we've seen very incremental higher highs being produced in the S&P 500 itself. Notice that stocks trading above their 50 SMA in the S&P, and this is a daily time frame chart, so it is apples to apples being compared here. We've seen more stocks recapture their 50 SMAs across the board. Speaks to a slight improvement from breadth, and obviously we are also above that 50% mark, but as we said, unfortunately, we need to wipe it away with some bearish data points. Obviously, the RSP equal weight is nowhere even close to its pivot high. You would have thought, based on the SPXA 50R, maybe this would have made a higher high. It's not the case by any stretch of the imagination. So this also continues to be a red flag for the S&P 500. Same thing with our Dow divergence. If we pull up this chart, industrials versus transports. Now, I will say this is looking quite promising as an ascending triangle, and if it breaks, it would give us some confirmation that yes, this higher high here is being validated, but as of right now, unless it actually breaks, it's hard to have that full-blown confident look in the move so far across all of the markets with all of these divergences taking place. Hopefully this behind-the-scenes look through the indicators has been worth it, right? And another one, we'll just jump right into VIX. No cut here. VIX has fallen off of a cliff in the VIX itself, but here we go. Lo and behold, we take a look behind the curtain one more time. What's the VVIX doing here? Huge spike in the upward direction. This should be unsettling. This should really be unsettling. What is this telling us? This is telling us that people are starting to get active in the VIX option chain, right? So if folks are getting active in the VIX option chain, what are they preparing for? Do they know something that we don't know about? Why is the VIX registering those lower levels? Obviously, it has to do with the 30-day option dilemma going on right now and the attractiveness of zero DTEs, but VVIX certainly uncovers a little bit of an issue. And even if we take a look at something like our futures in volatility, notice that we had an uptick on today's session. This is the 30-day registered options, right? So an uptick here, increasing a small amount of volatility. We're certainly not in a backwardation. We're far underneath the zero line. But for the most part, the direction there is kind of what matters. And certainly in the 9 versus 30-day VIX, registering shorter dated options, another tick higher. Again, I will concede we're still underneath zero. The world isn't ending yet, but it's something to start being concerned about. Why is volatility perking up as the market is trying to grind in the upward direction? Clearly, some folks are not too happy and not being paid here, and they're hedging for that liquidation break. That's my interpretation of volatility at this point. Taking a look at the QQQ, I think that this chart basically speaks for itself. We had a barcode section in here, attempted the gap up and breakout of range on the Tuesday session, completely failed, gapped into range on today's open, and we closed back outside of range in the upward direction over 318. A very, very tricky chart to be trading. Let's take a look at the hourly time frame just to make a bit more sense of the price action in front of us. I think that, at this point, it's got to be a stronger move over 320.50. If we're just chopping around in here, I think that the buyers have an edge, clearly trying to produce some sort of higher low, but for follow through, you've got to clear 320.50 in the upward direction. The bears will gain an edge when and if we can flush underneath 316.25. That, of course, would be on a failure to hold above 318 as we move forward. So it's almost like we had a choppy balance area, and now we're building another choppy balance area. It's slightly overlapping to up. So buyers trying to make progress, but again, where's the follow through? Where's the obvious trade setup for the long? it's not there until we can crack 320.50, right? That should be clear based on this chart. And the shorts really want to see here and then a flush of 316.25 get us to these equal lows back in this area. If we take a look at the market internals specific to the NASDAQ, we're also dealing with very weak inflows. Nothing impressive on the buy side from this market, never making it anywhere close to our significant reads here or here. The cumulative ticks are extremely compressed, maybe a small bearish edge on the Tuesday session, fading back into the range, right? And then in terms of the advanced decline line, it's a mixed bag. We have a muted move on Monday, Tuesday fades lower, and Wednesday fades higher. So very difficult to say who exactly has the edge, and we just saw that on the price action chart as well. So unfortunately, it's not like the NASDAQ has any hidden signals for us. I would say if anything, remembering that the Qs represent a heavy-weighted portion of the tech cohort for the S&Ps, the weakness here and the failure to really materialize over 320.50 just leans into the sort of thesis that, hey, we shouldn't really be trusting this breakout just yet unless the QQQ can actually clear the highs at 320.50. Let's take a look at market profile for our NQ, and I want to bring up the same idea with the single print and extremely thin structure from the Tuesday breakdown. Why was it that on today's session we technically looked above this very obvious shelf and there's just zero follow through, right? I get it, there was a significant trend that was put in place prior, but you would have thought with such a lack of volume, such a lack of overhead supply sitting there waiting to sell into it, that we could have rotated through it a little bit more. Now, granted, the point of control did technically close right at this area. It's a step in the upward direction. It's hard to say anything meaningful about it when in the prior day, right, the range is clearly to the downside and the point of control closes weak. So we're not really making substantial progress in one direction versus another. I will say that Monday does not have a poor low. We do have a decent low on today's session here in the NQ as well. The weak reference point would be the Friday low of last week. You can see how it's 2 TPOs across there. And if we just go back on over to Thinkorswim, that would equate to a breakdown of this level right around in here, which as we just discussed is a move underneath 316.25 to target 314. Last but not least for the broad market is the IWM stuck sideways in a balance area after a look above and fail on the Tuesday gap up. Nothing really impressive taking place here. This one is a patience play in its entirety. We're waiting for a break of this zone sort of right around in here on the IWM daily. Over 179 and 180.25 as a zone as a whole is certainly a break of an ascending triangle here, but it's hard to say anything bullish about that until the break actually takes place. We need to see the move through that and then potentially a higher low above to start feeling more bullish about the broad market. The break just hasn't happened, and with Tuesday's look above and fail, we should have lower confidence that we're going to attempt this again into the end of the week. Now, if it happens, great, we'll go with it, but based on what took place Tuesday, based on the consolidation back in the range on today's session, I'm not thrilled about upside outcomes. If we do break the bottom of the range, that's where we need to start looking at this 2-day balance in here. The lows are your key line in the sand at 172.75. So until we move out of balance here or here, it's really a neutral indication. And if the IWM, which has acted as a leader, is really just staying stuck neutral, it will be hard for the SPY itself to see follow through in the upward direction. Ideally, these two things move in sync. If the SPY sees an upside move, the IWM is also seeing an upside move. And as of right now, it is certainly divergent from that perspective, giving us lower confidence in the S&P breakout. Now it's time for a quick tour through the core list of companies, Apple leaving it zoomed out so you can see the previous targets from pivots at 170.50 and 174.75. Zooming in, this chart by far looks way better than the broad market itself. Technically, we have a bullish engulfer on today's session, testing underneath the Tuesday low and closing over the Tuesday high, as well as this 167 area of resistance. So we are looking for follow through in the upward direction out of Apple. Unfortunately, we don't really have great risk reward to position against here. We've seen a straight up move from the bottom up to the top, a little bit of flag consolidation here, but for the most part, what I would want to see intraday into the remainder of the week is a pullback that supports off of 167 and then rotates higher. The target is 170.50. You're asking for a bit much of continuation for something that looks like this. It's not out of the realm of possibility. Just note you're buying on higher highs now that we've seen an incremental break over the previous pivot top from in here. Breakdowns will be difficult to trade unless we put in lower highs underneath today's low, basically at 165.50. If we do get a retracement here and then a lower high underneath, that's where the downside outcomes really come into play underneath 165.50 in Apple for shorts to be on the table. Netflix is trying to resolve earnings. The IV is trying to cool off on the options chain, so just be aware of that if you're going to trade options on Netflix. It did produce a hammer candle, and it did produce that hammer off of a known area of previous structure. So ideally, just based on technical analysis, we see a break of the hammer high to target the gap close, and then a retest of the bottom of the overhead supply. I would look to position based on an intraday risk parameter. You obviously can't place a stop loss here and target this. Risk reward would be all kinds of funky on that type of trade. So intraday, if we see a move over the Wednesday high, look to position based on some sort of intraday high or low that offers decent risk reward to come in for the retest of 332.50. If we're just stuck trading in the earnings day range, I'm not necessarily thrilled about outcomes there, and you can see and make the case for a breakdown underneath today's low at 315.50 for a move in the downward direction to retest the origin of this breakout in here. 306.50 is the downside move. So that's Netflix. Let's take a look at Tesla. Obviously, they just reported earnings after the close, and we're dealing with 172 currently being the trade price. So let's just assume that we open on a gap down somewhere in this area. Clearly, it's a violation of the bear flag that we've been discussing here. Today's inverted hammer closed the overhead gap and then reversed into the close. Gap rules will be in play here. It's very difficult to make an assessment until we're actually at the opening bell for tomorrow. But if we are opening on a gap down, for the most part, what I would say is we're gapping red underneath a green bar automatically. That should tell you something about anyone who's trying to long through earnings. We're also breaking down from a bear flag. That's another bearish edge. And we have all of this overhead supply weighing on us here. The idea is probably to look for a filling of the gap lower high. So high, lower high off of the gap close. Then the better short would just be underneath 168.35 to start interacting and testing this gap from way back over here. Very difficult to build a long case unless we actually produce a higher low back inside of this range. Then maybe we're dealing with an inverted head and shoulders. All speculation. Wait for earnings to really resolve inside of Tesla. Next up is GOOGL. What's going on with the Goog? Really an interesting chart. Again, everything's pretty much positioned precariously based on previous structure. If this was going to turn into a double top, we had the lower high, a flush of the neckline, and a rejection in the upper wick, but we've closed right on it. So ideally, the bears see continuation underneath 103.75 in the coming days worth of trade. That keeps us underneath the double top neckline, and the target would be 100. If we start consolidating above 103.75, it's difficult to be a long in here considering we have equal highs and then lower high. Not really seeing the long case to be had unless we actually produce a higher low back above 106.50 to then tag this area at 108.75. Next up, Meta. What's going on with Zuckerberg's fantasy land here? Certainly breaking down from this balance and rejecting in the upper wick from today's session. I would look for continued rollover out of Meta. So to me, the ideal setup is looking for a break, retest, lower high, then continuation in the downward direction. We've been talking about in the pre-market lives the fact that this is turning into an ascending triangle, or excuse me, a rising wedge. Ascending triangle, very different pattern. Rising wedge here, indicating that longs with terrible location, again, what are they subject to do? Close out as they fail to continue to get paid up here at these highs. Step number one, breaking the support trend line is complete. Continued lower highs under 216.50. Hopefully you can see the case for pulling back to 207. Let's take a look at NVDA. What's going on? This is the stock that just cannot be shorted. It will not move lower. It fails to do anything for the shorts. Hopefully you did not position on the head and shoulders. We were advocates for not getting in early. On today's session, we opened underneath the inverted hammer low, rally up through the upper wick of the inverted hammer, looking like a threat of a breakout over 280. It's very difficult to say, again, that NVIDIA is a clear long. I would definitely favor long side outcomes on a 2-bar high break, also breaking the previous pivot here over 280. The target would be 287.75, but just do so cautiously, especially considering the positioning right now of the S&P 500. It's very difficult to be chasing this NVIDIA long, especially as we know after the mega rally from the whole AI fiasco. So that's NVIDIA. Shorts will also have to be patient for the neckline of that pattern. It's just not in play yet. Here's Microsoft. Look above and fail on the daily time frame chart. Ideally, bears see continued lower highs under 289.25. There were some shots fired from Mr. Musk on Twitter about a lawsuit potentially brewing about the training of an AI model, I'm assuming. So we'll see if that results in any headlines for tomorrow's session, but any lower highs, just from a very purely technical perspective, underneath 289.25, we should be looking for the bottom end of the range at 281.50, and then a breakdown there. Obviously, the gap is in play with today's close and rejection at that area. I'm still kind of favoring, hey, look above, fail, looking for downside. If it does poke above, it's got to be producing a higher low there to really confirm that resistance is now going to offer support. Last but not least, before our couple of trade ideas, is going to be Amazon. What's going on with the mini beast here? A break of the equal high. This one seems to be staying in the background, right? Nobody's coming after Amazon for an AI lawsuit or anything like that, at least not that I know of. So as of right now, bullish engulfer on today's session, completely erasing the red damage that was done in the preceding two bars, breaking out of a 3-day balance range here. I would be looking at Amazon as a top contender for a long, especially kind of staying out of the bearish headlines, so to speak. If this can produce higher lows over 103.90, looking for some follow through in the upward direction towards that daily 200 SMA and 108 as an overhead target. Not interested in the long, obviously, if we're trading underneath 103.90 and the short is only on a flush of the balance lows, that would require a full-blown look above and fail, and then the bottom gives out at 101.25 for a downside move. Based on the chart in front of us, I would have more of a long bias. Let's round out the video with XOM as our first trade idea. Again, no cuts for a couple of these segments on tonight's episode, so clearly just a breakout point at 117. We are dealing with a balance area here, and we have a 3-bar play with a little bit of consolidation in the upper 50% of the preceding breakout bar from low end of the range right to the top. So as long as we can hold on to today's low in the XOM here, we are looking for consolidation to continue or a break over 117. Look left. The next major target comes in at this previous high, up around 119.50. If you're trading that with options, $2.15, certainly worth looking for in the upward direction on a roughly $100 price stock. That is XOM in the upward direction. Not interested, obviously, if it never breaks, and not interested if we take out today's low in the downward direction. You could keep it on a short watch underneath the bottom of balance here, but that's not the main thesis of this particular chart right now. Let's take a look at ENPH for end phase as our last trade idea. This is number 2 for the day. And this is actually a short setup. Obviously, the longer time frame trend is down here. We are dealing with a downtrend, and we're looking at an inverted hammer on today's session as an inside bar inside of the Tuesday session. If we go on down to something like an hourly time frame chart, you'll also notice that we have clear as day a head and shoulders. So if we flush that neckline at 222.25, look left, there is thin structure. This is clearly a day trade, at least to the breakout origin at 215, offering, let's say that you missed the boat, you wait for a lower high underneath, you short at 220, a 5-point move in the downward direction, again, checks out as certainly being something to look out for, then potentially rotating through the thin structure here. Technically, that gap, it never really was a full gap based on the upper wick of that bar, but you get the gist. That would be the next major structure that I start to target at 211. So plenty of downside available here if this does ultimately want to turn into a head and shoulders and break that neckline. 222.25 is your level. That's going to wrap up today's episode of the Midweek Market Update. If you enjoyed the video or learned anything new today, let me know in the comments section or by giving the video a thumbs up. I hope to see every single one of you guys live tomorrow morning at 8:30 for the pre-market prep. And with that said, have a green trading week.